Hey, Todd, welcome to the show.
Thanks for having me, Tom.
Absolutely. It's a pleasure to have you. So for those of you listening, if you haven't met Todd yet, Todd Tresidder, is that how I say your name properly?
Tresidder.
Todd Tresidder. Todd Tresidder graduated from the University of California at Davis with a BA in economics and a passion for creating successful businesses. A serial entrepreneur since childhood, like myself, Todd went on to build his own wealth as a hedge fund manager before retiring at age 35 to teach others. Today, Todd provides advanced investment and retirement planning education at financialmentor.com, showing you what works, what doesn't, and why from his proven experience in business. Todd, it's great to have you.
Thanks. Yeah, and obviously age 35 was long ago, as you can tell from the gray goatee here, huh?
Yeah, so you've definitely been in the business world for quite a while.
Yeah, it's kind of scary to hear you say that, but yeah, I guess it's true.
Yeah, that's awesome. Well, tell us about your background a little bit, how you got started in business.
Well, my background's hedge fund investing. That's where I developed. I just saw my friends graduating and going into Cubicle Nation, and they had less freedom than the bums down at Santa Monica Park. And you don't know what Santa Monica Park is, but there's a famous park down near the ocean, and it's where all the bums live because they bring in all these support services, health services and food and all that. And so these guys have one of the best views in the world. I mean, it's just this panoramic view from the bluffs looking out over the Pacific Ocean. And they live in this beautiful park, and they spend their days there playing guitar and reading books, and they go to the library when it's cold, on the rare cold days in LA. And I was watching my friends graduate to Cubicle Nation. I was like, wow, man, these guys living in the park have more freedom than my friends do that went to college and went off and they're working hard. The only difference is these guys live in a nice apartment and they drive a Porsche, but they don't have their days to themselves. And I thought, I want freedom. That's what I cared about, was freedom. And so I started learning how to do it, and that led me into the hedge fund business, which taught me about investing. And then eventually we sold the hedge fund business, and I quote unquote retired at age 35. So that's how I got my investment chops. And then I went through a period where kind of fumbled around for a few years. And then my wife got sick and tired of hearing me just give people blow off answers as to how you achieve financial independence at a young age. Told me to try to do something with it. And so I started building Financial Mentor. And what I promised myself was I would quit. I would drop it if it ever turned negative, if it ever turned difficult. Because a lot of my ideas are very unconventional. They work, but it's not how mainstream thinking teaches stuff. And so I just kind of said, well, if it ever gets ugly, if people start attacking me or whatever, I'll just let it go. But the opposite has occurred. People have been really appreciative of, a voice that speaks straight up about how this stuff works, as opposed to puts out the regular stuff you hear everywhere. And so I've gotten really positive reception, and so I've just kept building it.
Mm-hmm. That's awesome. That's great. And so, you mentioned some of your ideas are a little bit controversial, maybe not how mainstream financial advisors would advise people to invest their money and manage their money and so forth. So what are some of those ideas that you learned along the way that most people might not understand or might think is kind of the opposite of traditional advice?
Let me count the ways, right? I'll grab a couple big ones right off the bat. Like one of them, I teach a concept in investment strategy called Expectancy Investing, where it's an active approach to investing, and it's all based on mathematical expectancy. And the premise is that the premise of traditional investment advice is commonly taught, which is, we'll call it low cost passive index buy and hold, or bubblehead philosophy, or any of those names that it goes by. The premise is that nothing can be known about the future, and therefore you must accept market risk at all times to receive a market return. That's the passive approach, right? And so you've got to buy and hold through thick and thin and endure all the ups and downs of the markets. Well, the way I teach investing is that nothing can be known. They've got that part correct. First of all, what they teach is valid, by the way. It's just not the most efficient approach to developing returns in the markets. There's a more efficient approach. And that is that their premise is correct, that nothing can be known about the future. But where they made an error is that not all outcomes have the same probability or expectancy. And that if you constantly align your portfolio with favorable expectancies, over time you produce higher returns with lower risk profile. And so there's mathematically disciplined ways to do that that don't require any sort of forecasting or any of the mumbo jumbo. And they work and they're well proven, but they're not commonly taught.
That's cool.
So that would be an example of a non-traditional approach, right? I mean, obviously you don't hear that everywhere. That's very non-traditional.
Totally. I mean, I've read a ton of books on investing and I actually worked with a hedge fund for a little bit right after I got out of college. But yeah, I've never even heard that actually, that, you can know nothing about the future. That's true, right? Is that the premise that you can't predict the future? Everyone knows that, right? But what you mentioned, I think the key point here is that not all outcomes have the same probability of happening in the future, right? So like maybe, aliens come to Earth, like what's the probability of that, right? In the next 10 years, very low, but what's the probability of Fed raising interest rates? Well, it's much higher, right? So that's not a very good example, but I assume.
Well, it's not just to be clear, I want to be clear on something. It's not just probability, it's expectancy. Because see, expectancy is different from probability. Most people think in terms of probability. That's very intuitive, and that's where people go when I mention this stuff. But I'm talking about expectancy, and expectancy is probability times payoff. And that's critically important when you understand the math of how money compounds, because the payoff is the critical point. You can't have large negative outcomes when compounding money, because the math of returning from those those large losses is very difficult. And so there's a distinction between expectancy and probability that's really important to understand from an investment standpoint, and that is that expectancy is probability times payoffs. So you're not just weighting the probability of the event, but it's weighted against what the payoff is should the event occur. And the key in investing is you have to avoid large negative payoffs. And that has to do with the math of how wealth compounds. It's just built into the math. It's not my opinion. It's just the way the math works.
Right. It's like if you're playing poker, you have $100 in chips, you lose $100 in chips, you're out. There's no way you can get back in that game without bringing more money to the table.
Yeah, exactly. And so, you don't want to go bet your entire night on a single hand and then be out, right? Because then you're out of the game. And you don't want to be out of the game in the game of life, at least. In a poker game at night, fine, you can go have another cocktail and just hang out and watch your buddies play. But in the game of life, where you're building your retirement nest egg and you've got one shot at it and one shot only, you can't be out. You have to play the game to where you come back another day and can survive. And so it's slightly different, but yeah, your analogy is dead on.
Gotcha. So then I assume, risk management is like a big part of success, because if you lose 90% or even 50%, it's really hard to come back from that. So what do you do for risk management?
Yeah, so risk management actually is central to everything I teach. So it's great that you glommed onto that right from the beginning. It applies no matter what field you're in, whether it's, because there's really three asset classes you work with in building wealth. You work with business entrepreneurship, right? Or you work with real estate, or you work with paper assets. And in all of them, risk management disciplines apply, but they apply in different ways. So the principles are identical across asset classes, but the way you apply them is unique to each asset class. So as an example, when I was buying rental real estate, as an example, I would buy large apartment buildings and I would use non-recourse financing. And so the non-recourse financing would limit the loss to the initial down payment because the lender only had recourse to the building, not to my personal assets. So that's an example of a risk management strategy in real estate where I could control more real estate with less money at risk. There's a different one like for business. In business, I've designed my whole business as a low-risk enterprise where basically I'm risking my time, not my capital. And then you can apply it in different ways in paper assets. So each asset class is unique in how you apply it. The principles are universal. They apply, and it has to do with the math of how you compound returns. Your goal is always to have higher highs and higher lows, because nobody ever gets it perfect. Everybody makes mistakes. Everybody has setbacks. It's just part of playing the game. If you're going to play the game, you're going to screw up and you're going to have problems. And so the winners are the ones that control the losses during the bad times and maximize and roll out the gains during the good times.
Definitely. That's really cool. So, okay, so you mentioned with the apartments, buying large apartments with non-recourse financing, and basically that means, if it goes bust, the bank can't come after your personal assets. They can only come after the apartment and whatever you invested in the apartment, right?
Yeah.
Yeah. So, and that to me, it sounds like what you're saying is that is one strategy that you used. And, there are times economically where maybe banks aren't lending as much and maybe you can't get non-recourse financing. So basically what you're saying is like, don't do that. That would be a big mistake because in that situation, you could lose everything from one apartment or one investment.
Well, it depends. It depends. You can also use valuation disciplines to control your risk. Again, valuation discipline applies across asset classes. You just use it in different ways. So as an example, in apartments, if you got a really screaming deal on a building that was large cash flow positive, your risk is extremely low at that point. Because by definition, you've bought below fair value if it's throwing off large amounts of cash flow. Because in theory, fair value should be break even. And if you pay a premium, then it's negative cash flow. And if you're positive cash flow, you bought under value. So, if you could buy a deal at extreme value, that's another risk management tool. The thing about real estate that's unique, and it's kind of a joke in the real estate business, right? Real estate never goes down, it just goes illiquid. Well, we know it's not true, right? Real estate does go down. We learned that in 2008, 2009. But you can't sell it readily. So you don't have a liquidity, you don't have the sell discipline to exit from real estate to control your losses. You can't say, oh, my building's down 10%, I'm out. If your building's down 10%, probably there aren't a whole lot of buyers for it, period. And so you have to have different types of disciplines in order to manage risk. One was the financing, as I explained, another is valuation. So these are different disciplines for controlling risk in places where liquidity doesn't allow you to control risk through a sell discipline.
Mm-hmm. Definitely. That's awesome. So any other great risk management strategies that you use, or is it really just evaluation and then, limiting your financial risk?
Well, I mean, we could spend an entire interview on risk management. I mean, basically what you're trying to do is you're trying to identify I'm kind of a freak in the sense that the first question that always enters my mind is, how can I lose money with this? Like most people are all enamored with how much can they make? And my focus, I'm so disciplined on risk management, my first question in my mind is always, how do I lose money with this? Tell me all the ways. And so I focus immediately on the negative. I try to find every way I can lose money with something. And then from there, I try to figure out all the ways to avoid that risk, to manage that risk away. And the objective is you want to build a portfolio of assets that the risk profiles, if you will, the risk profiles of those assets don't line up. And that way your portfolio is diversified at a very deep level, because it's diversified by the actual risk profile, not just through some product-based diversification like you get in the traditional paper asset diversification where, stocks, bonds, and everything all go down at one time during a big bad bear market. The thing about diversification is it stands on the bedrock of non-correlation. And if you don't have non-correlation, diversification doesn't add value in excess of costs.
Definitely. So I want to dive into that concept a little bit more because I think it's one of the most commonly, anyone who's really studied anything about finances or even watched, financial news, they talk about diversification all the time, right? But most people think that's just like, I'll buy an index fund or some mutual funds and that's diversified. So can you explain why that is not diversification in the sense that you're describing here?
Well, it is. First of all, it is diversification in the sense that you're diversified across product, right? You're diversified across multiple stocks. So what you've done is you diversified away stock-specific risk. What you haven't diversified away is market risk or strategy risk, right? So different risk profiles will come to bite you at different times. So you have successfully managed away through buying an index fund, you've managed away stock-specific risk. So when Enron bites the dust, it's not going to take your whole portfolio down, right? Because it's just a small piece of the entire index. So it hurts, but it's not a devastating deal. Whereas what I'm talking about is diversifying at a much deeper level. I'm talking about diversifying at the strategy level and identifying what the risk profile is to that strategy. So example, a buy and hold, using your example, a buy and hold strategy of an S&P 500 index fund, your risk, 80, 90% of your risk is market-based risk. In other words, when the market tanks, the fund goes down with it. And so that's the bulk of where your risk is identified. It's also the bulk of your source of return for that particular strategy. And so what you want is fundamentally different strategies and fundamentally different sources of return in your portfolio. So the real estate I gave you is a great example. That's a diversified source of return. My business is a great example because, again, these are all assets. That's something people often get confused on is they think assets are just stocks and bonds they can buy from their broker. It's not. you build your business like you're building your business right now. And as you build your business, you're building equity. And there's leverage points in it. There's tax advantages and all kinds of different things. It's an asset. I mean, if you think about when you buy a stock, all you're owning is a percent of somebody else's business. And in this business, you're owning 100% of it. It's still an asset. So the principles are universal. They apply across the board, and you can apply them, you just have to apply them in different ways based on the asset.
Definitely. So, for people starting out, maybe young people, maybe, aspiring authors, people who don't really have a big nest egg yet, what are some of the ways that, people all the time will, send me emails even like, I've got $10,000. What do I do with it? It's for people with small amounts of money. How can they, first of all, make sure they don't lose it and doing something, making a very poor investment that, have they asked your question, how can I lose money with this? They may be able to figure that out. So what are some of the great starter investments for people?
All right. Well, let's first of all start with the objective, of course, is to build wealth and become financially independent, right?
Yeah, exactly.
All right. So given that assumption, let's go into the formula of building wealth, because it's really quite simple. It's make more than you spend and invest the difference wisely. I mean, one sentence, that's everything you need to know about building wealth, right? So you just have, but let's break it down into its components. You have to make more, spend less, and invest the difference wisely. And so there's three components to the equation. And so when you look at how wealth building actually works out mathematically, you'll see that there's two stages in the life cycle of building wealth. In the first stage, it's most important how much you put away, your savings rate as percent of your spending. Okay, so I've actually got a post on my site called How Anyone Can Retire in 10 Years for Less. And it goes through the math of how, what percent savings you have and how long it takes you to achieve financial independence using that. And it breaks it all out. So high savings rate, you can be financially independent very rapidly. So that's, again, it's just built into the math. So that's the early life cycle, the early life cycle of building wealth is your savings rate as a percent of your total income or total spending. The second stage is the one most people focus on, but that's not really where you should start. So that's where you should start on the first one, is your savings rate. And that means spend less, and that means figure out how to earn more. Since there's a mathematical limit to how far you can go on the spend less, I generally try to encourage young people to focus on their earning capacity, how to increase their personal capital, if you will, their earning capacity. That's how you get the biggest bang for your time. But the key on that is you have to control your spending level while you do that. So as an example, the way I did it was when I came out of school, I went into the hedge fund business. I rapidly increased my earning capacity by working my way up to partner status in the firm. And I went into a solid six-figure income, and I never increased my spending beyond a college kid, because back then I didn't care, So I had a little condo down by Lake Tahoe. I lived near Lake Tahoe. I had a little condo. It was paid for. I mean, what do I need? I need a comfortable bed, a chair, a desk. Life was simple. And so I kept my spending down and saved gobs. And that's how I became financially independent really quickly. Now, the second piece of the equation was what I did when I was learning in the hedge fund business how to invest, which is the second half of the life cycle of building wealth is your return on investment net of inflation. So how do you increase your ability to compound wealth or compound those savings you accumulate? So again, the early spot is how fast you can save. The second phase is how well you compound those savings. But there's kind of a dividing line where you cross over. And so a lot of people just get it confused and they focus on the wrong thing at the wrong point in time. What I generally encourage young people to do is focus on your earnings capacity right from the get-go, build your personal capital, grow your business, whatever that is, try to really ramp up your earnings, make yourself invaluable, indispensable, all those things. And then, in the meantime, start developing your investment chops. Learn how to do that and make your mistakes with the small dollar amounts you're working with in the beginning, because you're going to make mistakes, you're going to screw stuff up. So do it with those small dollar amounts, those early savings, so that when you start working with bigger and bigger capital as you get older, you don't make those obvious mistakes.
Mm-hmm. Yeah, that's great advice. So I love that how you broke it down into phases. Like phase one, for young people don't have a big nest egg yet. Like you need to focus on earning more money, basically, and obviously, also like you say, controlling the spending. But there's only so much you can cut your spending by, right? So really without increasing your income, you're very limited to how much you can actually save and invest and grow your wealth long term.
Yeah, but there's another mathematical relationship that's interesting, and that's why I play both sides of the coin. The smart guy plays both sides. They don't limit themselves to one or the other. I've heard guys say, oh, it's all about your income capacity and make more, make more. The problem with that is if you don't control the spending, what happens is your financial independence number is a multiple of how much you spend. So as a ballpark, and this is just real rough ballpark, but at least it points to true north. It's never fully accurate because it depends on the individual. But basically, for every 1,000 a month you spend, you're going to need about 300 to 400,000 in assets. Now, again, it depends on the earnings capacity of the asset, all these other things, but it's just a general benchmark number you can play with. And so somebody that allows their spending to ramp up, 3,000, 5,000, 10,000 a month more than they really need to be happy, man, they just put that number so far away from themselves, they make it much harder. And so it's both pieces of the equation. It's controlling the spending and ramping up your earnings capacity. It's both, not either or.
Gotcha. That makes a lot of sense. So what you're saying is basically, and again, it's an average like you mentioned, but for every $1,000 a month you want to spend, you need at least $300,000 to $400,000 in assets in order to maintain that level of lifestyle, right? And is that forever, or is that coming from the standpoint? Because I know a lot of financial advisors will say your goal is have zero when you die, right? So you're gradually spending down that wealth. So is that to have basically unlimited monthly income, or is that?
Well, the idea of having zero when you die is nonsense, right? Because that would assume that this whole process has some relevance of science to it, and it doesn't, right? All these planning tools are just mathematical projections and assumptions. There's no actuarial science to any one person's life, right? Because you don't have statistical validity with a sample size of one.
Exactly.
So you could sit here and plan and an actuarially solid plan that would take you down to zero when you die, and it's pure nonsense for one individual. And that's all you ever will be, is one individual. So it works for life insurance companies and it works for the IRS, but it doesn't work for you or me. And so that's just not reality at all. If you're talking about becoming financially independent at a young age, which obviously you're talking to a younger crowd, and I did it at a young age also, what you really end up with is there's so little room for error if you're trying to spend down money over such a long period of time. In other words, if you're trying to amortize your assets, which is what you're talking about, right? Spend it down to zero. If you're trying to amortize your assets over a 60-year time frame, the room for error is minuscule. It's just it's non-existent. So what you really want to do instead, when you're looking for a long-term period of financial independence, is create a terminal wealth equation. You want to get to where your cash flow from your investments exceeds your lifestyle expenses. And at that point, you're terminally wealthy, right? Because you're always compounding and growing your wealth. And the distinction point from that to the other is not that large. And so you want to just go to a cash flow-based model, not an asset-based model. An asset-based model is what you're talking about, where you look at how much do I need to retire, you accumulate it, and then you spend it back down. But when you're looking at it from the other side, if you go from a cash flow-based model, it's much simpler and doesn't require a lot of assumptions about life expectancy and investment return and all these things you can't assume properly because there's no statistical validity to it. Instead, what you do is you just go to a cash flow-based model and you say, the dividends from my stock and the income from my real estate and the passive income from my business exceeds my expenses, therefore I'm terminally wealthy. As long as you have the assets and you're putting away money every month, you just keep compounding and growing that income, and it just magnifies.
Definitely. So, I never talked a little about business income. I know you're an author as well, Todd, a best-selling author. You've got several books out there, and I'm guessing you're probably earning some pretty decent money from them. So, for me, when I'm looking at that equation you just mentioned, is it easier for me to earn $1,000 a month selling books, or to have $400,000 in the bank, managed wisely in different investments? For me, it just seems way easier to, sell another $1,000 a month in books, and royalties at least. So, what are your thoughts on that? In terms of, especially in this initial phase, like phase one, when you're growing your income. What are your thoughts on, the business model of being an author, publishing, royalties, passive income, all that?
I love it. Obviously, if I'm part of it, I must like it. I look at it like I just explained to you. For every $1,000 a month of income I generate in the books, It's like a $300,000 to $400,000 asset. So, and it's creative, and you're building something fun, and you're helping people with the education you're sharing. So I love the book business, and I've been amazed at how stable the income stream has been from Amazon. I didn't, I tested it just to see how it would work out, and it's been remarkably stable.
Mm-hmm. And are you a self-published author, or do you have traditional publishers that you work with?
Yeah, again, this goes back to the principles I teach. No, I'm self-published. I can't understand why anybody would give away the equity value of their business, for a small pittance of a royalty or a, what do they call them, an advance, right? Why would I give away the equity value of that asset? I'd much sooner keep it and keep the residual income, and if I'm going to be doing all the marketing. My platform is what drives them. My marketing is what drives the sales. Excuse Sorry about that, man. So, why would I give all that away for a small upfront royalty? That makes no sense at all. Or a small upfront advance. See, I don't even know the terms. That's how foreign the idea is to me. It just makes absolutely no sense at all. I want the residual income because it has a multiple value. Like I said, $1,000 a month is worth $300,000 to $400,000 to me. I want that.
Mm-hmm. Definitely, that makes a lot of sense. Yeah, I mean, that's how I've always looked at it. But I almost felt like, maybe there's something I'm missing here, because it's a very uncommon viewpoint that $1,000 a month in income is worth way more than $500,000 in the bank. And like most people, they'd take $500,000 like any day of the week. But for me, I'm like, I'd rather have that passive income, because I think that's long term, especially as a young person, long term, I think it's going to be way more valuable.
Yeah, well, first of all, let's be clear. The number was $300,000 to $400,000, not more than $500,000. I don't want to exaggerate it. But then the other thing too, it's important that maybe intuitively you're picking up on, it's far easier to double your book sales by adding more books to your portfolio than it is to double your assets in the markets. And it's far quicker too. And so I would far sooner have the asset of the books and double the growth of the book business than I would to try to figure out how to double the paper assets. And I'm kind of an expert at that. So, that's telling you something.
Definitely. That's awesome.
I'm going to cough again for a second. Sorry, I just got a scratchy throat. Hold on a second. I'm going to cough and drink some tea.
Okay, no problem.
Sorry about that.
It's all good. Okay, so Todd, I know you've mentioned the 2 phases, right? And so phase 1 is increasing your income, reducing your savings, saving money, so that in phase 2, you can really focus on growing your wealth, right?
Yep.
And obviously along the way, you're kind of doing both. But, I know you're a coach and a mentor, and you work with a lot of clients and probably a lot of young people, who are in phase 1. So I want to walk through phase 1 first and then phase 2. So for people in phase 1 who are really looking at growing their income, building more wealth, what are the most common problems and challenges that people have, and what are the kind of solutions that you've been giving them to help them achieve that?
Phase 1, the biggest problem is, really reflecting your values and your desires in your spending and your lifestyle patterns and how you prioritize your life, your time. So, the whole world around you supports the idea of lifestyle. More, better, different. Go buy stuff. Find your happiness in the late cool car and the designer clothes. And there's advertising inundating you, and everything's about more, better, different. And to develop kind of more of a stoic position of, finding happiness inside yourself, and it's not found in things but in experiences. Going through all that, that's really the key, is identifying what your true deep values are and then honoring them through your spending. So it's not a right wrong statement, for everybody they reflect it differently. But in the end, it's well documented that once you get above abject poverty, more, better, different doesn't make you happy. And so, more income is not the key. The key is to identify those values that you most need to honor. So for most people that follow my work, it's freedom. Most people that follow my work have a high value on freedom. And then what they do is they mistakenly project that value of freedom onto an external object, in this case called money. And they think it's all about financial freedom. But it's really not. It's a personal freedom issue, of which finance is an important part of it, because it affects how you spend your days and what you can do and what you can't do. So it's important, but it's not the answer. So anyway, that's the starting point, is really, because otherwise what you do is you experience the savings equation as sacrifice. And that makes it no fun, and you can't stick with it. It has to be fun or you're not going to stick with it. And so the key is to recognize every dollar gets spent. Every dollar that passes through your hand, you're going to spend. You either spend it on lifestyle today or you spend it on freedom for tomorrow, right? Because when you invest it, think of it as spending it. You're spending it into your freedom account. And so you're going to spend every dollar. It's just a question of how you prioritize them and what's most important to you.
That's awesome. I love that. I love that you mentioned that values, how important that is. And I definitely resonate with that because, for me, freedom is definitely my number one core value, has been for a while. I've done quite a bit of work on core values. So I totally resonate with that. But one of the curious things that you said is you mentioned, spending according to those values. So can you give us some examples of how people can maybe shift their spending so that it more aligns with their values?
Well, I'll just give you examples from my own life. I have some things some people would consider a luxury, but they work for us. So for example, we have a motorhome because we love camping. We go to national parks, we travel around, we spend probably a month to 2 months a year living out of our motorhome. That's our value. So we spent a good chunk on that motorhome. But then again, I did it kind of strategically. I could afford to buy a new one, but why blow away the money? The unique thing of motorhomes is people buy them and then they don't drive them, and you can get a low mileage one that's got 5-10 years on it, but it has almost no miles. So it's essentially a new vehicle for 20-30 cents on the dollar of a new one. And so I found one that had been garaged. It had 11,000 original miles, and I got it for 30 cents on the dollar. So that's just being smart. I addressed my values, got what I wanted, and we go off on all these vacations and enjoy our life, and we're doing it for 30 cents on the dollar. I don't know. So, that's an example of reflecting values, right? I wanted the motorhome, but I also respect money, and I don't want to piss it away on something that doesn't deliver value for me. So I got 99% of the value of a new motorhome from a used one.
Definitely. Well, John DeMartini, I've listened to a lot of his advice on finances, and he talks a lot about core values as well. And one thing
I'm sorry, your name dropped out when you said that. Who was the name you were talking about?
Dr. John DeMartini.
Okay.
Yeah, I've listened to a lot of he's got some really good stuff on core values and finances. And one of the things he talks about is, most people are already kind of spending according to their values, right? Like, because most people are totally unconscious when you're buying stuff, you just buy what you want. And so it's kind of automatically in tune with their values, but sometimes you want to change that, right? Like, let's say someone listening today says, hey, I'm broke. I want to start phase one. I want to start building my income, building more savings. And so that requires a shift in value. So have you worked with clients like that who have had to make those value shifts, and what are some ways to go about that?
Well, what I explain is that, your health, wealth, and your happiness are a function of your habits. And so what you want to do is you want to look at your habits, because, you're going to compound your wealth brick by brick, day by day, hour by hour, with the hundreds of decisions you make every day. And so to answer your question, you want to get those decisions conscious. Most of them are made unconsciously. Most people don't even realize where they're blowing their money. So track it, make it conscious, and then just start deciding, do I really need that? Is that getting me the highest and best value for my money? Is that taking me toward my goals or away from my goals? Just start tracking it and asking these two questions and seeing what you come up with. I think you'll find that there's some very creative ways to get the value you want for a lot less money. And then you can start tracking those dollars towards savings and addressing that value of freedom. So it's about awareness and about consciousness and bringing it back to your habits. Most of what happens in our life comes from habit. Most of the results we produce is from habit. So if you can develop habits that take you towards your goals, you're most of the way there.
That's brilliant. I couldn't have said it any better myself. That's great. Okay, let's move on to phase two, Todd. What are some of the biggest mistakes people make in phase two, the investing phase? And how can they avoid those mistakes? And what are some great tips that you've had success with working with clients?
Boy, that one's huge, because that gets us all into what is expectancy investing. The best answer I have for how to invest in paper assets is expectancy investing. You've got real estate on top of that. The mistakes people make is they don't know what they're doing, and then they go in and they lose a lot of money. It's the thing about investing, it's really hard to accumulate capital. It's really easy to blow it. The number of ways that you can make a mistake in investing is huge. And all the things, it's kind of like, you have to get a lot of things right to profit, and you only have to do one thing wrong to lose. And so you just have to get really clear. That's why I was explaining that you want to start investing early on and make a lot of your mistakes early on with smaller dollar amounts and start developing the disciplines and the skill to avoid the obvious potholes. But, there's three ways in which you invest. It's your business, business entrepreneurship, real estate, and paper assets. And so you're really asking me to identify all the potholes and all the strategies, which is more than this podcast will hold.
Right, totally. I totally get that. There's a lot out there, that a lot of mistakes you can make. Like you said, like only one mistake, you can lose everything. But in order to earn, let's say $1 million, there's a lot of things you have to do right to get to that point. I totally agree with that. That makes a lot of sense. Yeah. So, but I'm trying to think of how to say this. Like, I think a lot of people feel stuck, right? Like when it comes to investing, maybe they're in index funds, maybe they're out of the market, but they've got money, they want to invest, but they just feel stuck. Like, how do I don't want to make the mistake, so they end up not really doing anything because they don't want to lose it all, and then they lose a lot of their money to inflation and so forth. So they're not really investing, right? Like they want to, but they are so afraid of making a mistake that they never even get into it. So like for someone like that who's feeling stuck, like I'm not sure what to do next. Obviously, they wouldn't want to jump in and like put all their money in one stock and lose it all. But at the same time, they don't want to just not do anything and not get anywhere. So, have you worked with clients like that, and how do you get them over that kind of frustration or roadblock of not knowing what to do?
Well, and again, I'm not trying to pitch a course that I don't even have to offer yet, right? That's my Step 5 Expectancy Investing course, and I've been teaching one-on-one clients that for a while, and I'm putting it in a course format. And so I have a process called 7 Steps to 7 Figures that I teach. What I've done over the years of coaching is I figured out that the process of building wealth is a 7-step process. Everybody maps into it at one step or another. And so what you're trying to get to is the 5th step, which is expectancy investing. And it's a big course. It takes 6 to 9 months to complete it. I haven't finished building it out yet. I'll probably be offering it starting the end of 2016. So that's my answer. It's a whole course. I'm not trying to use it. It's a layup for a pitch, right? But I'm not trying to do that. It's just I can't possibly soundbite it for you. What I encourage people to do, they have to learn, and they have to learn how to do this right, and they have to find somebody they can trust to learn from. There's a lot of pitchmen out there. There's a lot of, I call it the blind man and the elephant in the investment learning space. There's a lot of, have you ever heard that old Indian folk tale, the 3 blind men and the elephant?
Yeah, definitely.
Okay, so just for listeners that don't know it, 3 blind men go up to describe an elephant. The first guy goes up and grabs the tail and says, "Oh, an elephant is like a large rope." The next guy grabs the back leg and says, "Ooh, an elephant is like a giant tree trunk." And the third guy grabs the ear and says, "The elephant is like a giant fan." Each guy's partially right from his limited experience, and each guy's missing the entire totality of what is the elephant. And so that's the problem you have in the investment advice space is you got a lot of blind men. You got a lot of people that are seeing parts of the elephant on the part that they're trained for, and so they're preaching dangerous half-truths. And they don't get, this stuff's ruled by mathematics. The growth of wealth is ruled by mathematics. The expectancy of your assets is what determines your compound return, and all that's ruled by mathematics. There's provable science to this stuff. This isn't just conjecture. So anyway, you have to learn it. You have to understand how this works to keep from being deceived by all the blind men out there.
Definitely. That's the perfect answer, I think, honestly, because I think that's true. I think, I've been like big into personal development for like 10 years, so I've gone to a ton of seminars and seen a lot of people just pitch, the stock trading course and the stock investing course and the, real estate investing and the real estate flipping and the, all these different things. And like you said, they're kind of like that blind man with the elephant, and maybe they got to do really well with, working with the elephant's tail, working with the real estate. But when it comes to actually getting a holistic picture of what it takes to be financially successful overall, it's not really what they're selling and not really what they're teaching most of the times. And I think a lot of people spend a lot of money, and I know I made this mistake. I invest a lot of money in different investing courses and programs and stuff, and it, definitely was underwhelmed with the results that I got. So
the way I learned what I did was I had a thing called the $100,000 garbage pile, which was, when I was in the hedge fund business, part of my job was to go buy everything out there and go test it. So the difference was I bought it all, I learned it using the hedge fund's money, but then my job was to go put it to the test and do the research and prove out whether it held up or not. And amazingly, almost nothing holds up. I mean, I was buying $3,000, $5,000 courses and flushing them down the toilet. I mean, I would go prove them out and they didn't work. So, you know, that's where I developed all this. That's where I developed. I mean, the stuff that works is pretty simple. It's not complicated, and there's reasons why it works, you know, and you have to be able to identify that.
Yeah, definitely. Well, I love it, Todd. You shared just an absolute wealth of wisdom with us today. I'm blown away, and I'm really impressed. And I'd love to have you on the show again to share even more. But before you go, tell us if we can find out more about you and the work that you're doing.
All right. Well, thanks, Tom. My site is financialmentor.com. That's financialmentor.com. And for new subscribers, I give away a couple. I have a podcast too, by the way. And then for new subscribers on the site, I give away 2 bonuses. I give away a free ebook, 18 Essential Lessons of a Self-Made Millionaire. And I cover some of the stuff in the ebook that we talked about here, but I also cover a lot of other stuff we didn't talk about. And then I also have a course called 52 Weeks to Financial Freedom. It's an email course. It's totally free, and no, it's not get rich quick despite the title. What it does, though, is in 52 weeks, it goes through a lot of the main principles and the framework that everybody travels through to achieve financial freedom. And so it gives you kind of a roadmap or a structure for what you can expect and how to plot your course. And again, that's totally free, and it's just kind of a way I build a relationship with new subscribers. So all that's available at financialmentor.com for free.
That's awesome. Thanks so much, Todd. Appreciate having you here.
All right. Thanks for having me on the show, Tom.